Hey everyone, so back for part 3 here. All right, we're talking about replacing equipment, which I think somewhat speaks for itself. I don't think we need to go into what that means. Let's get right into it with some numbers. A machine with a book value of $80,000 has estimated 5-year life. A proposal is offered to sell the old machine for $50,500, replace it with a new machine at $75,000. New machine has a 5-year life, no residual value. The new machine would reduce annual direct labor costs from $11,200 to $7,400. Okay, so really what's our decision here? Our choice here, our differential analysis, is really simply old machine, new machine. Right? That's our comparison. And I just want to kind of go read through this again for a second, at least the very beginning. A machine with a book value of $80,000. Guess what that is? That's a sunk cost. I don't care. All right, so let's just pull that number out of there. I just want to cross it off and not even think about it. All right, so now let's start looking at these numbers. Okay, the old machine. So we're going to do revenues and we're going to do costs here. The old machine doesn't have any revenues. You'll see the new machine will, so just kind of hold that thought for a second if that doesn't make sense to you yet. Okay, so no revenues. But the old machine does have some costs. The old machine has, it says the new machine would reduce the annual direct labor costs from $11,200 to $7,400. So there's some direct labor costs associated with the old machine. Really, it's $11,200. And, and we're looking at 5 years here, right? Because it has an estimated 5-year life. So 11,200 times 5, we still have $56,000 in costs here. So $56,000 in direct labor costs associated with the old machine. Okay, so really this machine operates at $56,000. I hate to say loss, but I mean costs, right? There's no revenues coming from it. Okay, alternatively, let's say we decided to go with a new machine. Well, with a new machine, we were going to sell the old machine. It says we're going to sell the old machine for $50,500. So we actually do have some revenues if we go with the new machine. We are going to sell the old one. And we have some costs associated with the new machine. It says that we're still going to have costs of $7,400 per year related to the new machine, right? So that's $7,400, and it's for 5 years. So that is, I'm going to cheat, $37,000 in costs. So we are going to have $37,000 in direct labor costs. There is one other thing. We have to buy the machine, right? So that's a big outlay of costs. So there's another $75,000. That's how much the new machine is going to cost us. All right, so we've got that big outlay of cash. So the net of all of these things from buying the new machine would be out $61,500. All right, so clearly it is to our benefit to stick with the old machine, right? We say that, but maybe the old machine is really like slow, right? Maybe it's out of date. Any of those things can be true. But from a pure differential analysis standpoint, you'd be better off sticking with the old machine, all right, from costs. Okay, we are going to do, I think, one more, accepting business at a special price. Now, here's the thing with that. Okay, there's one more new book, something called, I want to say processing, processing like ingredients. It's almost like processing oil or something. Do we process something further? That is so specialized. It's just, to me, absurd that's even in this book. Like, I mean, if you guys are at some point processing like oil, crude oil from the ground into different octanes of gasoline, then by all means come back to me and be like, Professor Anderson, you never taught us. But until then, we're just going to pretend that one doesn't exist in this chapter. All right, so accepting business at a special price. And we went over something like this a few chapters ago. The idea is whether or not we would do something for, normally we sell a product for a certain price, and do we sell it for something less to a customer, kind of like as a one-off? Is it worth it to us? All right, so let's look at this. Product A is normally sold for $9.60 a unit. A special price of $7.20 is offered for the export market. The variable production cost is $5 per unit. An additional export tariff, which is like tax, of 15% of revenue must be paid for all export products. Okay, it says assume there's sufficient capacity for the special order. The reason I even tell you that is because what they're saying is we could take on this special order without it hurting our existing business. We have the room for it, we have the time for it, we have the facilities for it. It doesn't add any extra costs for us to do this extra order. Okay, so that's why they kind of give you that piece there. Okay, so our options are whether or not to accept or reject the order. They have it in this order, reject and then accept. So that's how we'll write it up here. Reject or accept. All right, those are our I can't speak. Those are our alternatives. Okay, so if we reject the offer, obviously we have no revenues from it, and we have no costs because we have rejected the offer, right? So this is only related to the special offer. It's not like, do we have costs in the business overall? This is just about this offer. So if we reject it, we don't make any money, we don't lose any money, whatever, okay? What if we accept the offer? Well, if we accept the offer, we're going to have revenue of $7.20. And this is per item. Obviously, it's for however many they're buying, right? But we'll have revenue of $7.20 we wouldn't have had before. And we've got some variable costs. We've got $5 in variable costs, production costs here. And we've got taxes, right? So that's our variable costs. And we've got taxes of 15%, which is, trust me, $1.08, which is $7.20 times 15%. So it's $1.08. Okay? So if we accept this offer, we are going to make $1.12 we wouldn't have made before. If we rejected this offer, we would make nothing. If we accept this offer, we're going to have $1.12 that we wouldn't have had before. Now, $1.12 obviously doesn't sound like much, but let's say it's for 10,000 units or something. Now add some zeros, right? Add 3 zeros onto the end of this, or 4 zeros. All right, the idea is you will make money accepting this offer. Now, it's a short-run decision. You can't make these decisions on a long-term basis because at the end of the day, you still need to make enough of a profit to cover your fixed costs. But since your regular everyday business where you're selling it for $9.60 a piece is covering your fixed costs, if you were to take on this one special offer in the short run, you can make a pretty nice boatload of money from it. Now, overall, the thought process here is even if you're making a penny, and you're going to want to remember this for your homework, even if you're making a penny beyond your variable costs, okay, you should be accepting the offer. So what does that mean? So you've got variable costs of $6.08 here. I know it doesn't really work with taxes, but let's say $6.08. If somebody offered you $6.09, again, this doesn't quite work because of taxes, but just play along. If somebody offered you $6.09, like 1 penny of your variable costs, you should accept the offer because it's money you wouldn't have had otherwise. And if you're making, like I said, 10,000, 100,000 units, it could add up pretty substantially. Okay, so that's what you're going to have to remember. Even if, remember the words as I'm saying them, even if you're only making a penny more than variable costs, it should be worth it to you. Okay, short run decision. All right, that is kind of it with the math in this chapter. Well, the real heavy math in this chapter. I just want to hit the last couple of things that the chapter talked about. I didn't want to leave them off. Oops, I'm getting cut off there. And we actually kind of talked about this a little bit in the decentralized operations, but we're going to talk about it a little bit, just cover it a little bit more here. How do businesses set prices? Well, there's market-based methods. You can choose market-based methods to set prices, meaning what is the demand in the market? How can you, if everybody's charging $5, well, then you're probably going to have to charge $5 too if your products are basically the same, right? So it's demand-based, how you set the prices. All right, competition-based, well, actually it's kind of the same thing, what I just said. All right, well, maybe I really need to re-say that. All right, demand-based. What would the demand for the product be? I said that a little bit backwards. What would the demand for the product be? So if the demand, something like pet food, right? That's a product that you wind up having to pay the price no matter what it is, you have no choice but to continue to buy the product, so it's based on demand, right? Competition-based, sorry, that's the one I should say. If everybody's selling it for $5, then you need to sell it for $5 too. I take that all back, that I said that a little bit backwards. All right, economics, that's not my thing. All right, the other way you can set prices, and this is the way the accountants would like things, right? We don't really care, and we do care, but we don't really care about what the market is. But we do know, as accountants, we need to cover our costs. So usually the best way that accountants like to set up prices is cost-plus methods. And there's a couple of them that are covered in your book. We're only going to talk about one of them a little bit here. You don't have to go into any level of detail beyond what I'm covering right here in this video, but the chapter goes on for a few pages about it, okay? So I'm not interested in you going into that level of detail. Anyway, cost-plus method. The idea is, what does it cost to make the product, which we know, because that's what we've been doing all semester. What does it cost to make the product, plus I want to make a little bit of money on everything I sell. That should be the selling price. So let's say my product is $100. That's how much it costs me to make the product. and I want to make a 10% markup. I want 10% on top of that. So I really want to then turn around and sell it for $110. That's the idea here, okay? Cost plus method. That's the one that makes the most sense to accountants, or at least to me. When you're talking about the cost per unit part of it, the idea is we're talking about the product cost, right? What is the direct material? What is the direct labor? What is the factory overhead? That is the product cost. Plus what I want to mark it up. Well, when you're marketing it up, realize that extra markup, that 10%, 20%, whatever it is that you want to mark it up, has to then cover all the other costs of your business, right? It's got to cover all the administration. It's got to cover all the, potentially selling expenses, selling administrative expenses. And you want to make money after you pay all of your costs too, right? So that markup has to be a well thought out number. You have what it costs you to make the product. What do you need to sell it for beyond it to cover all the costs of your business and still make money? That's the accountant kind of approach. All right, so there's my little example, kind of the same thing I just shared with you. Okay, last term I want to cover in this chapter and then we're done. A bottleneck. A bottleneck is a point in the manufacturing process where the demand exceeds the ability to produce the product. And the idea is that it looks like a bottleneck, of which I don't have, well, I guess I do have kind of a bottle in here. Hairspray. Okay, the idea is that it comes to a point and then nothing else can make it out, right? I don't even know why this is in here. So your manufacturing process is going along, and then something happens to kind of put a cinch on it that only a little bit then comes out at the other end. So a bottleneck is something in manufacturing that you want to make sure that you stay ahead of, because what it does is you're making the product, you're doing well, and then all of a sudden you can't get the stuff out the door fast enough. Okay, so a lot of times bottlenecks play a big role in manufacturing process, or at least identifying them and trying to make them as minimal as possible. And there is a fantastic video. Fantastic. And I've linked it on the outside in Canvas as well. And it's an I Love Lucy episode, and it's all of like 4 minutes. It's probably one of the best episodes that are out there. Please watch it. All right, bye everyone.